Hi everyone, this video is on when to actually pull the trigger to buy forwards, options, colors, whatever instrument you have on your mind to actually hedge your exposure, to hedge your future risk. Okay, let me start from the graph. And let's think, it's a philosophical question. There is no answer. I will tell you from the beginning. And this is how I think about it. This is not a science. And there is no science behind it. Okay, let's suppose this is your currency pair. This is timeline. This is rate. And Euro USD, like for simplicity. This is parity. This is 0.9. This 1.1, this 1.2, we are somewhere here. And it was like that before. And now we are here. Okay. Question. You have your strategy in place, you have your volumes, you kind of have a sense what instrument to use. Will you actually execute your trade today? Will you? I don't know. It's a philosophical question for me at first instance, and I was trying a lot of techniques to kind of make it more scientific. I've tested moving averages approach. Moving average is technical signal when faster moving average crosses slower moving average on its way up. It's a technical signal to buy. And it doesn't work, to be honest. I've tested a lot of times with different moving averages. It works perfectly at the historical data, and it doesn't work at your data that wasn't used at the education of the model. So it doesn't work. You kind of can, for example, I've tested from 1999 2020, and I found out that if we choose 47 days as a slowly moving average, as a fast moving average, and about, I don't know exactly, but let's say 163 days as slower moving average, we would have great result at that particular time period. But for the time of until now, it gave minus 1%. And here it was, I'm making it up, but it was approximately plus 47% of positive result on the trades if we use these as a signal. So it doesn't work, and it really does not work according to a lot of studies. So I'm not using it. Okay, what else we have in our list? We have budget rate. We have the counting rule. I will just put it as an accounting. I'll explain. You may use hedge accounting only under certain criteria, and one of the criteria is that the probability of your exposure is high. and that usually means 80 or more percent. So to use hedge accounting, you have to be sure that your expense, if you're hedging your expense or outflow in the future, will certainly happen in the future. That's a good indicator, actually, because it's kind of hard rule. If you don't have that understanding, you're not hedging if you want to use hedge accounting. That's the rule. Budget rate. Really good one, because it's kind of also hard element, hard rule, because it's something that you or C-level agreeing at the high level. So you can take it as a rule. And I like it. Like, I mean, if you see that your market rate, let's say your budget rate is 1.2, budget here, and you see that your current market rate is 1.15, go ahead and hedge. No need for you to wait for better rate. It's already good enough for your board, for your directors. So go ahead and do your hedging. That's not a science. It's just a rule. Do it. Okay. If not that certain, if let's say your budget rate, okay, 1.14. I like to think in terms of the risk, value at risk. You should check what is the volatility measured as sigma at the market. You can pull historical data for volatility and see if current volatility is higher or lower than the historical volatility. You then put it into the value at risk formula, and you will get the number. And if that number higher than approved by your budget committee, by your CFO, or whoever takes that decision in your company, then you should consider hedging regardless of the rate. But obviously, you should discuss it with your committee. That's not a question. That's procedural thing. You cannot avoid it. Okay, so check in sigma. If it's higher than usual, it drives your value at risk up. You go to your boss and you tell exactly what you see. Current rate, you're telling, hey, current rate is higher than the budget rate, but value of at risk increased significantly. So we are trying to match these two parameters, and we see that currently is better to hedge at 1.15 and avoid excessive risk rather than wait and with no certainty hedge or not to hedge at our budget rate. Because you never know. It might go here, or it might go there, or it might stay here. And let's say plus 1 year might be that different, and that difference might cause millions of dollars of functional currency fluctuation. Yeah, that's my message actually. There are a lot of other signals, but my point here, it's proved that it's impossible to outperform foreign exchange market at a long enough period of time. Because fundamentally, foreign exchange rate is a game between multiple players. between multiple countries, it might not go to zero, and it might not go to space as share price, because it's something relative between two economies, three economies, multiple economies, and countries trying to get more favorable conditions for them by playing with exchange rates and interest rates, by playing in change of interest rates to influence changes in exchange rates. So it's a play, and it's not predictable. It kind of might be predicted at the short run, but you will never know. You cannot put the system in place to be 100% sure that the rate will go up or down. Okay, so I propose not to use it. I propose definitely to use budget rate, because it's a hard signal. You know it. It's your North Star. You go to accounting. If you're applying hedge accounting, it might not be necessary, but if you want to apply it, you have to have documentation in place proving that the risk you're hedging against of will certainly happen, or with probability more than 80%. And I encourage you to use value at risk, because all this exercise, I mean hedging, it's about risk mitigation. It's not about earnings, losses. It's all about risks. And that's what you should deliver to the stakeholders. If you lock in the rate 1.16, your functional USD, and the rate ends up to be 1.05, you will lose in theory. Not actually, it's not actual raw loss. You would end up better off with no hedging, but you already hedged. And management might come to you and tell, hey, you've lost a lot of money for the company, but it's not the case, because the purpose of exercise is to decrease risk, and risk is measured by uncertainty. Uncertainty is variation in rate. If you fix the rate, you buy certainty. So it's all about buying the certainty in exchange rate, or the price of commodity, or price of anything, of share, of stock. So hedging is about predictability. It's not about outplaying the market. And these three signals I treat as the major ones for most of the corporate hedging programs. Okay, thanks for watching me. See you soon.